In July 2025, according to Reuters, U.S. crude exports to China plunged to their lowest level since October 2021, with Beijing importing 0 barrels of American oil for 5 straight months. Bloomberg reports the energy sector is confronting a harsh new reality. China has effectively erased U.S. crude from its shopping list ahead of key trade negotiations. While Washington debates tariffs like it's still 2018, Beijing is quietly signing long-term oil contracts with Russia and Iran, settling in yuan and locking in discounted prices. The world's largest oil market has just closed a door the U.S. thought would never slam shut. If America is no longer China's oil supplier, what leverage does it really have left? For much of the past 2 decades, U.S.-China energy trade was a story of mutual convenience. After the shale revolution transformed America into a net exporter of crude, China emerged as one of its most important customers. Tankers loaded in Texas and Louisiana would cross the Pacific to feed the world's fastest-growing economy. The arrangement fit perfectly. Washington found a lucrative outlet for surplus oil, while Beijing diversified away from politically volatile suppliers in the Middle East. Even when trade tensions escalated under the Trump administration, energy often remained a pragmatic bridge, one of the few areas where business prevailed over politics. But the cracks began to show after the 2018 tariff battles. Oil was briefly swept into the crossfire, with Beijing imposing levies on U.S. crude in retaliation for American duties on Chinese goods. Though those tariffs were later eased, the relationship never fully recovered. By 2023, China was deepening ties with Russia, whose discounted barrels offered a cost advantage too significant to ignore. At the same time, Iran, long a pariah in Western markets, found a willing buyer in Beijing, moving millions of barrels monthly through a network of dark fleet tankers that skirted sanctions. Meanwhile, structural shifts were underway inside China. Domestic crude production rose steadily, and the government made aggressive investments in renewable energy and electric vehicles, aiming to peak oil consumption by 2027. These trends meant that dependence on any one foreign supplier, especially a geopolitical rival, became less attractive. The quiet disengagement accelerated in 2025. Without formal announcements, without a public spat, China simply stopped buying U.S. oil for months. What once was a symbol of interdependence is now a reminder of how swiftly global trade flows can be rewritten when economics and geopolitics align against you. From Washington's perspective, the decision to keep pressure on Beijing's energy imports was rooted in both domestic politics and a belief in economic leverage. Under the Biden administration, and with echoes of Trump-era trade rhetoric still resonating, U.S. policymakers doubled down on tariffs, sanctions, and export controls as tools to influence China's behavior on issues ranging from technology transfer to human rights. Crude oil, while not always at the center of public debate, was embedded in this broader strategic posture. In late 2024, U.S. officials quietly extended certain sanctions targeting shipping firms and insurers that facilitated Russian oil exports, hoping to indirectly squeeze China's access to discounted barrels from Moscow. But Beijing interpreted these moves as economic coercion. The U.S. also maintained its 10% tariff on Chinese goods in several sectors, a policy Trump initiated and Biden refrained from fully dismantling, creating a tit-for-tat atmosphere in which energy became one of the many levers of influence. American oil exporters, particularly those in the Gulf Coast region, felt the tension. Companies that once counted on Chinese refiners as stable, high-volume customers began to pivot toward European and Latin American markets. Yet, the shift wasn't seamless. Europe's demand for U.S. crude had softened, falling 14% year-over-year by mid-2025, according to Reuters. The industry also faced infrastructure overcapacity, pipelines, export terminals, and shipping commitments built on the assumption that Asia and especially China would remain a growing outlet. Washington's strategy carried an implicit assumption that China's vast energy needs would ultimately compel it to return to the American market even if alternative sources were explored. That assumption underestimated two factors. First, China's willingness to endure short-term disruptions in exchange for long-term strategic gains, whether in securing favorable terms from Russia and Iran or reducing dependence on the US dollar in commodity trade. Second, the rapid transformation of China's own energy landscape, with domestic output and renewable generation expanding faster than most analysts predicted. Politically, the White House faced pressure from both sides of the aisle. Hawks argued that keeping oil sales to China undermined US leverage in broader strategic competition. Industry advocates warned that losing the Chinese market would harm American producers and cede influence to geopolitical rivals. The administration's compromise, maintaining some restrictions while avoiding an outright export ban, pleased neither camp fully. In practice, the policy left American crude in a no-man's land. Not so restricted that sales were impossible, but politically complicated enough for Chinese buyers to view them as unreliable. When Beijing finally halted purchases for 5 consecutive months in 2025, it was less a single act of retaliation than the culmination of years of accumulated mistrust. The U.S. had tried to play both the role of energy partner and strategic competitor. China decided it no longer needed to indulge that contradiction. For Canada, the fracture between Washington and Beijing in the energy space is more than a headline about two superpowers. It's a direct challenge to its own economic calculus. Canada, like the U.S., is a major crude exporter, but its market access is far more constrained. The vast majority of Canadian oil exports still flow south to the United States, not overseas, due to pipeline geography and infrastructure limitations. When American crude loses a key customer like China, the ripple effects inevitably reach Canadian shores. Ottawa has long explored ways to diversify markets, most notably through the Trans Mountain Expansion project, designed to open Pacific Coast access for Alberta's oil sands crude to reach Asian buyers. But as of mid-2025, that diversification strategy is colliding with an awkward reality. The very market Canada had hoped to tap, China, is in the midst of reshaping its supply lines away from North America entirely. With Beijing doubling down on Russian, Iranian, and Middle Eastern suppliers, Canadian producers face the prospect of investing in costly export infrastructure only to find the largest Asian buyer uninterested. Canadian officials publicly avoid framing this as a geopolitical snub, but privately, there's concern. The federal government's clean energy transition agenda means the long-term domestic role of oil is shrinking. So foreign markets are essential for sustaining industry revenue in the interim. Losing potential footholds in Asia risks accelerating the economic decline of certain regions, particularly Alberta and Saskatchewan, where oil remains a primary driver of jobs and provincial budgets. The situation also tests Canada's diplomatic balance. Ottawa has tried to maintain cordial economic relations with Beijing, even as it aligns closely with Washington on security and human rights issues. But in the world of commodities, goodwill is not enough. Chinese refiners operate on a calculus of price, stability, and political risk. And right now, Canadian crude faces all the same political risk discounts as U.S. barrels, without the advantage of scale or established shipping routes. The irony is that Canada might have benefited, at least temporarily, from U.S.-China tensions if Beijing had sought alternative North American suppliers. But China's energy strategy appears to favor suppliers outside the U.S.-led geopolitical orbit altogether. That leaves Canada in a similar position to its southern neighbor. With world-class production capacity, sophisticated infrastructure, and no clear path to regaining a share of the most dynamic oil market of the last 2 decades. By August 2025, the contours of the standoff were clear. The U.S. had not formally banned crude exports to China, nor had China explicitly outlawed American oil. Instead, The trade relationship had simply withered into near non-existence. In the absence of official dialogue on energy, both sides moved to solidify alternative arrangements, Washington by deepening ties with European allies, Beijing by cementing long-term deals with Russia and Iran. For Canada, the stalemate is equally binding. Infrastructure projects aimed at Asia remain politically contentious and financially risky if the largest potential buyer won't engage. Producers face the choice of doubling down on the U.S. market, which is itself in oversupply, or chasing smaller, more distant customers across the Pacific. Neither side has an easy off-ramp. For the U.S., re-entering the Chinese market would likely require softening sanctions and tariffs, a politically toxic move in an election cycle. For China, resuming purchases would mean reintroducing vulnerability to U.S. political pressure, something its entire energy strategy now seeks to avoid. The result is a kind of quiet freeze. No dramatic diplomatic breakdown, but no path back to the golden era of oil trade either. Every month that passes without significant shipments makes the rupture harder to reverse. And in a world where energy relationships are measured in decades, not fiscal quarters, both North American exporters and Chinese refiners may already be living in the post-US-China oil era. On the western edge of Alberta, in a small community that has long lived and breathed the oil sands economy, the ripple effects of China's disengagement are beginning to feel tangible. For years, local producers had pinned hopes on the Trans Mountain Expansion Project, TMX, the multi-billion-dollar pipeline designed to carry crude to the Pacific coast for shipment to Asia. The pitch was simple. Asia, and particularly China, would provide a stable, lucrative market for Canadian heavy crude, diversifying away from near-total dependence on the United States. But by mid-2025, with TMX finally operational, the reality is jarring. According to trade data, China's imports of North American crude have dropped to effectively zero in recent months. Refiners in Shandong and Guangdong, once prime targets for Alberta's product, are now taking record volumes from Russia and Iran at steep discounts, often priced in yuan instead of US dollars. These barrels arrive via dark fleet tankers, sidestepping Western sanctions and undercutting any price Canadian producers can match. For Alberta's economy, this isn't just a lost sale, it's a lost future. Provincial budgets rely heavily on royalties from oil sands production, and forecasts had factored in a gradual ramp-up of Asian exports to balance declining U.S. demand growth. Without Chinese buyers, cargoes intended for Asia are being redirected back into an already saturated U.S. Gulf market, where they fetch lower prices and face stiff competition from domestic American light sweet crude. The human cost is also creeping in. Service companies that invested in new equipment for expected Pacific trade are seeing orders dry up. Port communities in British Columbia, anticipating steady tanker traffic, are handling fewer shipments than projected. And in Ottawa, policymakers face an uncomfortable truth. Even with infrastructure in place, the absence of market demand from China leaves Canada tethered to a single dominant buyer. The very dependency diversification was meant to solve. In Port Arthur, Texas, home to some of the largest refining and export facilities in North America, the absence of Chinese demand is equally disruptive. Gulf Coast terminals were built and expanded in the past decade with the assumption that Asia's thirst for crude, especially China's, would keep dockside activity humming. For a while, that assumption held true. In peak years, China bought over 400,000 barrels per day of American crude, making it a top destination. Now, with Beijing absent from the ledger for 5 straight months, the landscape has shifted. Tankers that once departed full for Ningbo or Qingdao are now waiting longer for alternative charters, or diverting to shorter haul routes toward Europe and Latin America. The problem is profitability. Asian voyages, though longer, offered higher netbacks due to sustained demand and favorable price spreads. Shorter runs to Europe often bring thinner margins, especially in a market that, as Reuters notes, has seen a 14% drop in U.S. crude imports year over year. Producers and traders are feeling the pinch. Spot prices for certain Gulf Coast grades have weakened relative to Brent, eroding revenues. Midstream companies face underutilization of pipelines and marine terminals designed for maximum throughput. Even ancillary industries, from tug operators to port logistics firms, report reduced activity. For American consumers, the impact is less direct but still present. When exporters lose access to premium-paying markets, they sell more domestically, which can initially lower prices at home. But over time, the loss of high-margin exports discourages investment in production, tightening supply and potentially driving prices back up. It's a slow burn effect that doesn't make headlines until it hits the pump. In Washington, the political fallout is also notable. Lawmakers from oil-producing states are pressing the administration to find ways to re-engage China or secure equivalent markets, while hawks argue that losing Beijing as a customer is an acceptable cost of strategic competition. Meanwhile, the industry is left navigating an uncomfortable paradox. America is producing near-record volumes of crude and yet struggling to find buyers willing to pay what it once commanded. North America now stands at a crossroads in its energy relationship with the world's largest oil buyer. The infrastructure is built, the production capacity is here, yet the key market is gone, not with a bang, but with a quiet, calculated pivot. The U.S. is wrestling with the political cost of reopening energy trade with a strategic rival, while Canada is confronting the economic cost of investing in access to a customer that no longer answers the call. For both, the question looms: is this the inevitable reshaping of global energy flows, or a self-inflicted wound that can still be healed? In the new era of oil diplomacy, silence can be as decisive as sanctions. If you found this analysis valuable, like the video, share your thoughts in the comments and subscribe for more in-depth reporting.